The first point is economic conditions. Economic conditions such as inflation, unemployment, and GDP growth can have a significant impact on the stock market. For example, if inflation is high and the economy is slowing down, it can cause stocks to decline as investors become worried about future growth. On the other hand, a strong economy with low unemployment and robust GDP growth can boost investor confidence and drive stock prices higher. The second one, interest rates. Interest rates play a big role in the stock market as they can impact both borrowing costs and the value of bonds. If interest rates rise, it can make bonds more attractive to investors as they offer a higher return, leading them to sell stocks. This can cause stock prices to decline. Conversely, if interest rates fall, stocks may become more attractive as investors look for higher returns, leading to an increase in stock prices. The third one is political stability. Political stability is an important factor that can impact the stock market. For example, if there is a change in government, investors may be uncertain about the direction of economic and monetary policies, leading to increased volatility in the market. Political stability also affects investor confidence, which is a key driver of stock market performance. The fourth one is natural disasters. Natural disasters such as hurricanes, earthquakes, and other events can have a major impact on the stock market by disrupting supply chains, damaging infrastructure, and causing business closures. This can lead to a decline in economic activity and a decrease in investor confidence, causing stocks to decline. Next one is geopolitical tensions. Geopolitical tensions between countries, such as trade wars or military conflicts, can create uncertainty and fear among investors, leading to a decline in stock prices. For example, if two major economies are in a trade war, it can lead to decreased demand for goods and services, which can impact global economic growth and hurt stock prices. Another one is company-specific risks. Company-specific risks, such as changes in management, lawsuits, or declining earnings, can impact individual stocks and cause fluctuations in the market. For example, if a company announces a drop in earnings or a lawsuit, investors may become worried about the future prospects of the company and sell its stock, causing its price to decline. There have been several instances of stock market declines in the past 100 years, including the Great Depression, 1929 to 1939. The stock market crash of 1929, also known as the Great Crash, was a major factor in the Great Depression. The stock market declined by 89% from its peak in 1929 to its trough in 1932. The dot-com bubble, 1997 to 2000. The dot-com bubble was a period of speculation and rapid growth in the tech sector. The stock market soared in the late 1990s, but eventually, many tech companies failed and the market declined, with the Nasdaq Composite Index falling by 78% from its peak in 2000 to its low in 2002. The global financial crisis, 2007 to 2009. The global financial crisis was triggered by the collapse of the housing market in the United States, which led to the failure of many financial institutions. The stock market declined by more than 50% from its peak in 2007 to its low in 2009. The COVID-19 pandemic, 2020. The COVID-19 pandemic caused widespread economic disruption and resulted in a global recession. The stock market experienced a sharp decline in March 2020 as investors panicked about the economic impact of the pandemic. The S&P 500 index fell by 34% from its peak in February 2020 to its low in March 2020. These are just a few examples of stock market declines in the past 100 years. It's important to note that stock market declines are a normal part of investing, and that over the long term, the stock market has historically provided a good return for investors. However, it's also important to understand that past performance is not a guarantee of future results, and that investing in the stock market carries risk. Some general sources that provide information on the history of the stock market and stock market declines include the websites of major financial news outlets, such as Bloomberg, The Wall Street Journal, and Financial Times, which provide up-to-date news and analysis on the stock market. Government agencies such as the U.S. Securities and Exchange Commission, SEC, and the Federal Reserve, which provide data and information on the economy and financial markets. Investment research firms, such as Morningstar and S&P Global, which provide research and analysis on the stock market and individual stocks. Historical archives, such as the New York Times Archives or the Library of Congress, which provide historical news articles and reports on the stock market. Books on the history of the stock market and investing, such as A Random Walk Down Wall Street by Burton Malkiel and The Intelligent Investor by Benjamin Graham. These are just a few examples of the many resources available on the stock market and stock market declines. It's important to do your own research and consult multiple sources before making investment decisions. Thank you for your time.